Okay, so here we have a problem where we have this Morgan company, oops, and they have credit sales of $1.5 million. They have an accounts receivable balance of $840,000, and there has been uncollectible accounts of $37,000 that were written off. So if they were doing the direct write-off method, what A asks is how much would their bad debt be? So so if we were doing A, it would be $37,000. But this is not GAAP. So we really are not going to follow that. But that would be what it would be. Okay, then if we move on to what is GAAP, so then what is GAAP is B. So then B says, assume that the Morgan Company uses the percentage of receivable basis to record its bad debt, and that it concludes that 4% of the accounts receivable will become uncollectible. What is our bad debt expense, and what will the company record for their allowance of doubtful accounts if there's a current credit balance of $3,000? So if we go to our accounts payable, or I'm sorry, our accounts receivable, it's $840,000. And if we estimate that 4% of that will be uncollectible, you know, based on past history or whatever, that gives us a $33,600 allowance for doubtful accounts. So that the key to that is what we want our account to be. So then when we have to take it to the next step to say, okay, well, what is it now? If the balance now $3,000, then $30,600 would need to be recorded. And then our entry would be bad debt expense for $30,600, and then we would credit, oops, can I get it to indent? Then we would credit the allowance for doubtful accounts, if I can type, for $30,600. Okay, then the next thing, let me try to make this a little bit smaller if I can. Try to move it over here, okay. Then the next one says, okay, now what if, assume the same facts in B, except what if there's a debit balance of $1,000? So again, if we want to have $33,700 credit balance in the allowance account. Goodness, I can't type. So then remember, it should be a credit. That's kind of the key. That's why I made that all bold, or I'm sorry, all large case, all caps. So right now there's a debit. So we would need to reverse that, which would be $1,000 plus the $33,600. So that would be $34,600. So again, oops. Let's see if I can make this a little bit smaller. So again, I'll do the journal entry. So then the journal entry is going to be bad debt expense for $34,600, and then a credit to the allowance for doubtful accounts, $34,600. Okay, then it doesn't ask us to do this. Let me see if I can scoochie this a little bit. No. It doesn't ask us to do this, but what we would do is, if we were to then write those uncollectible accounts off, we would come over here then we would debit the allowance for doubtful accounts. For the 37,000, and then we would credit accounts receivable. Now again, when you're thinking about that, you're looking at that going, well, but we don't even have that much in the doubtful accounts. You're right, we do not. So then that's what they would have to, you'd then at the end of the year, you'd have a debit balance in that allowance for doubtful accounts, and then they probably need to reconsider their 4% estimate. So maybe their 4% estimate's a little too low. But that would be the entry that we would make to write that off. So you want to be able to kind of analyze all those scenarios, whether you're figuring out how much the bad debt expense is based on what the current account has, or you're writing off those debts. Now remember, say that we end up 3 months later collecting some of those. What we do is we do 2 different entries. So if we collected bad debt that we had already written off, we first have to reverse this entry, put it back into accounts receivable, credit the allowance for doubtful accounts, and then record the cash and release the accounts receivable. So if we ever collect it, we have 2 more entries that we have to do.